Hi, and welcome to this week's episode of Money with Alpha. This week, I wanted to record a very practical episode, and there are going to be some visuals. So, if you would like to watch this on YouTube, I'll put the link in the show notes. Otherwise, you can continue listening. And I will be talking about budgeting, which before you go and find a different podcast to listen to, I'm going to make this as interesting and simplistic as possible. And more than just budgeting, what I wanted to talk about is how to connect a business budget to a personal budget. Because something I see a lot with clients and other business women is they have a very separate way of managing their business finances to their personal finances because they think their accountant and bookkeeper are taking care of everything to do with the business. And to a certain extent, they're taking care of part of it, but it's not up to them to manage your day-to-day cash flow and help you understand what things are necessary, what things aren't, how you can optimize, how you can structure things better. Quite often, I find they're so, like the accountants and bookkeepers are so focused on the compliance side of it that anything like in terms of optimizing is not necessarily part of their scope or really what they do. So it's best to have a chat with your accountant if this is something they can also help you with. But the day-to-day budgeting side of it, that's generally going to be something that you will do. And that is an area that I definitely help with. So if you do want some help in this space, please reach out. I have a number of different ways that I do that. And I'm actually going to be running a workshop on this in the next couple of months as well. So stay tuned for that. So specifically, when we talk about the business budget, I'm gonna open up my first visual here. I'll just have to share my screen to do that. Here we go. So I talk about things in terms of like pies. And the reason I do that is because as a business, your income will fluctuate. So from month to month, your sort of monthly profitability will go up and down, depending on clients that come in. If you've got some steady income, that's great. But there may be other fluctuations in there as well. And expenses will certainly fluctuate too. A lot of things we pay nowadays, we sort of pay in like installment plans and it's on a monthly basis. But there are some things that will go up and down too. And there's some things that are annual, some things are quarterly, some things are monthly. So it's how to actually manage all those ebbs and flows. And that's where I find the concept of the business money pie and the percentages comes in really handy. In order to get to the percentages there, and these are just indicative, the ones I have on the screen at the moment. And for those who can't see it, what I'm talking about are things like having your operating account, which has sort of approximately, say, 30% or so of your operating cash in there. And that's just to pay the bills that come in and out. And a lot of them are direct debited these days. So we kind of have to have a certain amount of money sitting in there. And if you're paying staff, wages, all of that kind of thing, it comes out of your operating account. So you've got to calculate and make sure that that 30 or 33% I have in there at the moment will actually cover all those expenses. And for that, you do need the more detailed budget listing out all your income on a monthly basis, all your expenses on a monthly basis, so you can then see how these percentages work. So I'll get back into the detail in a moment, but the pie itself, sort of the rough slices, and you'll probably, if you've ever read, I'm going to miss Mike Michalowicz. I should really remember his name better. Profit First, basically, his book, then some of this will be familiar to you. I have simplified it a little from there, but the principles are very much the same. So your profit component, at the moment on this particular screen, I've got 5%. That can vary. So that really depends how mature your business is. Your profit might be 20%. Even if you're only paying yourself 1%, it's better to pay something rather than nothing because it's the discipline of getting into it, of doing it, of having it there. And this is different from your salary. This is not owner's salary. That's another slice of the pie. So after that 5% profit, we then make sure also that you have money set aside for tax. Now, being an ex-corporate tax accountant, I actually get excited when people pay tax as a business owner because it means you're earning enough money to pay tax. So I realize we want to try and minimize it as much as possible, but it's actually exciting if you're paying it. So I would go, yay, cheer, yay, you that you're paying tax because that's a good indicator of the fact that your business is healthy from an accounting perspective. Cash flow, however, becomes another thing, which is why I'm so passionate about the concept of cash flow. And that's what's sort of driven this episode. So tax, I have a percentage there of 17%. In Australia, small businesses are taxed at a rate of 25%. However, that's on top line revenue. That doesn't take into account all of the many tax deductions and expenses that you can have. So you're effectively probably paying closer to 17, but again, that figure you could actually get from your tax accountant to make sure that you're putting money aside. If you're already paying PAYG installments for tax, then this pie slice might not be necessary, or depending on what your whole budget forecasting process looks like, you might need to put a bit extra away if you're earning more this year than you did last year, so that you've got that money aside to pay that extra tax that you're going to be paying because you've earned more. So there's some nuances to this, and I don't want to overwhelm you too much. So, but for the moment, have a tax account anyway. Then you've also got your owner's salary. Really important to pay yourself a salary and to put money aside into your superannuation alongside that. I won't get too much into that because we'll look at that in the next step. But in this particular pie I've got on the screen, the owner's salary is 30%. So that could be higher or less, lower, depending on on what your overall budget looks like. But it's important to do that and to pay yourself if you can calculate a steady amount. So I realize 30% is going to fluctuate up and down, but if you can translate that into a single amount every month, whether that's $5,000 or $10,000 or $2,000, whatever it happens to be, and then that translates over into your personal money pie, which we'll get to shortly. So then there's also something I've got there called a holding account. That's for anything in excess of what needs to be in your operating account. It's an excess of profit. It's an excess of tax. It's over and above salary. It's money that's sitting there to pay for any extras that just happen to come up. It's a little bit like your business emergency fund, or to cover the costs that don't come out monthly. So for instance, if you're paying something on a quarterly basis, then obviously if you've only got enough money in your operating account to cover all the expenses for that month, then you're going to need to draw out of your holding account to cover that extra expense that comes in, that only comes in once every 3 months. So that, and it same thing goes if you've got annual expenses, but you can calculate out what that is once you have your budget. And I realize it can sometimes feel a bit daunting to do this, and you may not like things like Excel or Google Sheets, but I highly recommend just becoming comfortable enough with them. I recently worked with a client who has dyscalculia, and I am blown away by how well she took to this. And it's really, once you get it going, and you can see, you can have forecasts, you can have your actuals, you can monitor things and do it in a way that empowers you to make the right decisions. So you can see the months where there's dips in income because perhaps you work on a very seasonal cyclical business, and you can see dips happening around Christmas, for example, or around school holidays. And you're like, okay, well, what else can I do to supplement my income in those months? Because now I can see it. Until then, you're flying blind and it's very difficult to make decisions. Or your business might sort of drop away a little bit in the wintertime. Perhaps, you have something to do with swimming or things that just don't necessarily get as much attention. Or you might work in personal fitness and you find that most of your business really starts to kick in around August, September, when people realize, oh, I'm going to have to wear a swimsuit in a few months. I might need to start getting into shape again. So whatever it is, you'll start to see the trends, and you'll probably have a sense for them anyway. But unless you've got the numbers behind it, it makes it really difficult to make some decent decisions. And having the money pie on the back end of that budget, it makes it a lot easier to then manage the ebbs and flows that come with business. So I hope you're still with me and following, and that this is not too dry. So then the next thing that comes out of that is taking your owner's salary and sending that, because that's essentially your wages. So if you were employed, this would be the amount that you earn every month. And then from that, you have a household to run. Whether you've got a partner or not, you're going to have personal expenses as well. And like I said, if you can manage to make the owner's salary like a solid amount, so figure out from a percentage perspective what works, and then average it, and then pay yourself that amount every month, because it will make managing the uneven cash flow in your business stay in the business space. And then in your personal budget, you can actually then manage your money a little easier. It makes it a little easier, especially if you have a partner is not in the business with you and they have a steady salary, you can add the two together. Or if your partner is, make sure you're paying both of you a salary out of your business. And then that becomes the amount of money that you have to work with. And then you can look at your expenses alongside that income and go, it's amazing how many times I go through this with clients and they look at their expenses and go, right, I didn't realize I spent quite that much on groceries. Or I didn't realize I spent that much money on fuel or on clothes or extra bits and pieces, shining a light on it. While at the idea of it might not sound great, when you actually see it, you go, ah, okay, yep, I had a sense. I didn't realize how much it was. And I do this myself. Like I look at it too. To be honest, over Christmas, it just got a little out of hand. And I remember looking at my budget in January, just going, that's yeah, that there was a lot of money spent on food. And to be honest, a couple of trips to Costco in a quarter can definitely bump up the cost of groceries. But then the cost of groceries after that goes down substantially because I only go every sort of quarter or so. But leading up to Christmas, I went twice in one quarter. So it's amazing how easily these things can bust out of what your expectations are. But once you know, then you can go, okay, all right, I need to pull it back a little bit and make sure I get back into my rhythm of what I normally do. Get back into the habits that you've set up. And if you don't have them set up, then look at setting them up. I have episodes on that as well. So yeah, so back to your money pie. Once you have that view and you've got your salary and your expenses, look at, and your owner's salary is going to cover the bulk of your costs. So in the image I've got in front here, I've got a bills fund, which is essentially your personal operating account or your personal bank account. And that's about 70%. Generally, if you have a home loan or if you're renting and you've got like home costs, all of the things that go with that generally sits at around 70%. If it's more than that, I would highly recommend you doing a bit of an expenses diet or an expense audit, depending on what wording you prefer, and seeing how you can bring that down and try to get your day-to-day living expenses down to, and your bills down to 70%. I then look at, I call it a rainy day fund. You could call it, I also can call it a buffer fund or an emergency fund. Either way, we all need money set aside for when stuff happens that we hadn't planned on. Some electrical item breaks and we've got to replace it, or something goes wrong. Someone has an accident and there's medical bills, whatever it is. I usually assign about 10% of my available money to that because it makes it easier when something does happen, and it does. During COVID, oh my goodness, our hot water system broke. The washing machine broke. Shortly after we moved into our house, the pool pump broke. The dishwasher broke, of course, when we had family staying. So all these stuff happens and you can't really plan for it. So that's what the rainy day or the emergency or the buffer fund is for. You must have a fun fund. If you've heard me talk about money, you will know I harp on about this. At the moment on this pie, I've got 5% of your monthly available money set aside for fun. It's guilt-free fun is so important to our mental health. And if we don't do it, we will feel so constrained by our money that we will bust out beyond anything and we'll regret it. So being able to have guilt-free fun is extremely important. Investing. If you're at the point where you might have another carve out. So you might be at the moment I've got investing at 10%. You might want to carve that into two. If you've got school fees, you might want to have like 5% for school fees, or you might want to have them in your bills, however you prefer to structure it, because each of these pie slices represents a bank account. And I put them into, apart from the bills account, that sits in just an everyday transaction account, but all the others I put in a high interest bank account. I don't invest it. I don't like to touch it unless I have to, but it sits off to the side in separate accounts so I can see exactly what it's for. So the investing one is for if you want to top up your super. So that could be if you're a business owner, you can put your super. I've got 10% there, which generally speaking, superannuation should be about 14%. So see how you can manage that. Because I realize with when you're in business, quite often we reinvest in our businesses and we don't pay ourselves super. But as women in particular, especially if we've taken time out to have kids, superannuation becomes extremely important. So figure out if you can maybe use that pie to put into your superannuation and top that up. I've got 5% there for a car. I don't think, apart from myself, who I tend to have cars for a really, really long time. My last car I had for 20 years, and this one, all going well, it'll last about that long too. So I like to put money aside. Most people are going to buy a car within the next 2-3 years, rather than constantly putting yourself into more personal debt, and the personal debt interest rates are a lot higher. I know you can try and scoop it into your home loan, but still, you don't want to be paying that off for years and years to come. So if you can really save for a car, and then once you've got enough money to buy a reasonable car that you want and can afford, just pay for it outright And it feels so good to own a car rather than having to spend 5 years paying it off and end up paying almost double what the car is worth, especially considering that a car does not increase in value unless you get something extraordinary. So that's generally how I help people manage budgeting when it comes. So once you've got your detail in like the detailed budget and then you have your money pie, it tends to tick away each month. You can just tweak the figures once you've got money that's actually like you can see what you've actually spent. And if you want to keep it relatively high level, you can go, okay, here's what I've earned in the month. Here's what I've spent in the month. Here's what's left. This is how I'm going to carve it up amongst rainy day fund, invest in car, because the bills have already been deducted. So if you want to make it that simple, you can. But it's really important to have the discipline to put all that other money into another high interest bank account. And if you're paying yourself a steady salary, you could even automate that money. Your business money pie is a little bit difficult. That one you're going to have to make manual transfers because you are dealing with fluctuations. But if you have that steady owner's salary, you can then automate a certain amount every month, provided that you get your bills portion as close to correct as possible into all these other accounts. So that way you can actually start to see your money grow. So I'm just going to stop sharing again. But I can't even explain. If you haven't experienced it, you're just going to have to take my word for it. But seeing money grow in a bank account is actually really motivating in itself. I often get asked, well, how do you have the discipline to keep at it and not dig into these accounts? And I said, well, once you actually start to see you do it, so the belief, a half belief kind of starts, then you start to do it and you see the results, and then the belief gets bigger and bigger. And as long as you believe that you can do it more than you disbelieve it, then you're ahead of the game. And once you start to see that money grow and that you haven't dug into it for a few months, and then another month passes and another month passes and the money keeps on growing. And you're like, oh my God, this is so exciting. And acknowledge that as well. And then something will probably break, but you're like, that's okay. I have my rainy day fund. So it's all good. All the other bank accounts will stay untouched and they will continue to grow. Or say, I don't know, the world at the moment seems to have been taken over by Pink and Taylor Swift concerts. So say someone big's coming to town again and you want to buy tickets, but they're like $180 a ticket. You got a fund. And as long as you've got enough in there to pay for those tickets, you might even want to go for the VIP experience. But you see what I mean? You start to have choices. And you might then go, you know what? I'm actually going to choose not to do this because I like to see the balance grow in those funds. And you actually do get to that point. And that's where it starts to get really exciting when you know that you're managing your money in a way that allows you choices, it gives you freedom, and you can start to see it grow. And you're not going to wonder every time you go to tap the card at the grocery store, will there be enough in that account? That will start to disappear and you'll have a completely new identity when it comes to money. The beliefs of yours will change, and what you reinforce and what you attract will start to change, and who you are as a person, as an individual with a relationship with money will start to improve because you'll be proving it to yourself, and your beliefs can then catch up more than they were, because you have to have a certain amount of belief in yourself to even want to change. And then once you move beyond that, then the world is your oyster and you can start to really amplify the impact you have in your business too. So I hope you found that useful. If you do have any questions, please reach out, because I do realize I covered a fair bit in that, and it can get a little bit detailed and trying to connect the dots. But I'm happy to answer any questions you have, and please have a wonderful rest of your day.